If you blinked this week, you missed it. A silver candle so violent it doesn't look like price discovery, it looks like a message. They're calling it the Greenland God Candle, not because it's cute, because it hit like a meteor. Silver was trading around the mid-90s, and then, bam, an overnight geopolitical fuse went off. Reports of President Trump escalating tariff threats toward Europe over Greenland lit a safe haven stampede, while the physical market was already tight. Reuters noted silver briefly hit a record high near $95.87 on January 20th, 2026, as trade tensions and risk-off flows surged. Reuters. Now here's the part that matters, the gap. A gap up so clean it hasn't filled. And in technical analysis, an unfilled gap on a higher time frame is not a meme. It's a scar. This is education, not advice. I'm not telling you to buy, sell, or do anything. I'm giving you a framework for reading what the chart is screaming. Cool? Good. Let's translate what you're looking at. On the weekly chart, a true breakaway gap is when price leaps out of a well-defined range so fast that the market never trades the in-between prices. It's the chart equivalent of a crowd hearing a rumor and sprinting for the exit. Most gaps fill. That's why traders obsess over them, because in normal markets, price likes to repair inefficiencies. But breakaway gaps, those are different. Breakaway gaps happen when the market is repricing the asset, not just reacting to a headline. It's a regime shift. Old supply zones stop functioning, and the chart starts searching for a new where is fair level. When a breakaway gap stays unfilled, it's often telling you there wasn't enough metal for sale at those prices, and price had to jump to find sellers. Why gaps? Usually fill, and why this one might not a gap fills when two things happen. 1. Fear cools off, and 2. Liquidity returns. Think of it like a room that suddenly smells like smoke. In a normal room, people look around, realize it's toast, and sit back down. In a panicked room, people don't ask questions. They run, and the space behind them stays empty for a while. That empty space is your gap. For this gap to fill, the market has to decide the catalyst was temporary, and it has to find real sellers willing to reload inventory at those skipped prices. That's harder in silver than people admit, because silver doesn't just sit in vaults as a monetary asset. A lot of it gets used, consumed, gone. Why this gap is scaring people? Because the gap fill crowd is trained on normal markets. But silver right now is not normal. You've got two forces stacking on top of each other. 1. Safe haven, demand, the fear bid, trade stress. Plus, geopolitical brinkmanship forces institutions to hedge. You saw it in gold hitting record territory the same day. Reuters. When big money is nervous, it doesn't debate, it allocates. 2. Industrial scarcity, the need bid. Silver isn't just a shiny thing. It's a critical input metal. Electronics, solar, EV power systems, advanced contacts, thermal management, medical devices, grid components. When manufacturers need it, they don't wait for a dip. They secure supply. So you get something rare, fear money, plus factory money, bidding at the same time. That's when price stops acting like a commodity and starts acting like a strategic resource. The anatomy of the Greenland God Candle. Let's break this candle down like a crime scene. The open, above a ceiling that used to act like a roof. The body, wide, aggressive, not a hesitant grind. The close, near the highs, meaning buyers didn't get exhausted by Friday. And the gap, a blank strip of air where nobody got filled. If you want a simple rule, a breakout that happens with the gap is a breakout with urgency. Because the market didn't negotiate, it jumped. The weekly breakaway gap setup. Here's the simplest way to read the chart. Step 1, identify the box, a consolidation range on the weekly chart, months of trading where sellers repeatedly defended a ceiling and buyers kept reloading. Step 2, watch the escape, a weekly candle that opens above that ceiling, never looks back, and closes strong. Step 3, check the air pocket. The gap is the empty space between last week's high and this week's low. No trading happened there. That's the market screaming, we skipped the negotiation. Now why does that matter? Because those skipped prices become a ghost zone. If price ever revisits it, it's often fast. But if it never revisits it, the gap becomes proof of urgency, proof that the market moved from maybe to must. Breakaway, gap versus exhaustion gap, this matters. People see a gap and assume it's the end. That's dangerous. An exhaustion gap tends to happen late in a move after euphoria, when everyone who is going to buy has already bought. It often gets filled quickly because there's no new fuel. A breakaway gap tends to happen at the start of a new leg, right as the market escapes a range. It's the moment the crowd realizes the old price was too cheap for the new reality. So your job is to ask, did we gap out of a long box? Or did we gap after a parabolic run? This week's story looks like a box escape, not a top-tick fireworks show, and that's why people are whispering repricing. Okay, $95 to $250 in 14 days? Is that real? Let's be careful with words. Is it a guarantee? No. Is it a forecast? Not from me. But is it a plausible scenario in a stressed, supply-tight market with a geopolitical catalyst? Yes, because silver can go vertical when liquidity disappears. Here's the math, just to respect the scale. $95 to $250 is roughly a 163% move. Over 14 days, that's about 7%, 8% per day compounded. In a normal commodity, that's fantasy. In a forced covering event with shortage psychology, it's not impossible, it's just violent. So instead of prediction, we do mechanics. To go from roughly $95 to $250 in 2 weeks, you need 4 gears to lock together. Gear 1, a continuation gap, a second gap or a second launch candle on the weekly daily that confirms the market is not mean reverting, it's trending. Gear 2, shorts lose the exit. When price gaps above resistance, any short positioned for the usual pullback suddenly has no good place to cover. That creates forced buying. Forced buying doesn't care about valuation. Gear 3, physical premiums stay elevated. If coin, bar, and wholesale premiums stay bid while paper prices rise, that's the red flag. It means the physical market is following, not disagreeing. Gear 4, a new policy shock. Something that changes supply expectations instantly, export restrictions, new tariffs, logistics disruption, sanction threats, or a sudden industrial procurement scramble. And notice something. All 4 gears are about availability, not feelings. Why Greenland matters more than it sounds. People laugh at geopolitics until it hits supply chains. Greenland in this story isn't about ice. It's about alliances, Arctic lanes, minerals, and leverage. Reuters reported EU leaders pushing back hard, calling tariff pressure over Greenland a strategic mistake and signaling a unified response. Reuters. That's the point. When major blocs threaten retaliation, markets price uncertainty, and uncertainty makes capital run toward assets that don't require permission. Now layer that on a metal that industry already treats like oxygen. That's how you get the God Candle. It's 2:14 a.m. Someone in a Treasury department isn't watching memes, they're watching risk. A headline hits, tariffs, retaliation, shipping, politics. And the question inside the room isn't, is silver overvalued? The question is, can we still source what we need on time at any price? That's when orders hit the market in a way chart watchers can't emotionally process, because it's not investor behavior, it's procurement behavior, it's survival behavior. And when that kind of order flow arrives during thin liquidity, price doesn't climb, price teleports. That teleport is your gap. The simple model. Price is paper, shortage is atoms. Here's the trap most people fall into. They stare at the spot chart and assume the market is calm because the line is smooth. But the real market is the plumbing. Delivery terms, spreads, back orders, premiums, warehouse movement, and who is refusing to sell. In a shortage, the paper price can lag the physical reality until it doesn't. Then the chart catches up in one ugly jump, like a gap. And once you see a weekly breakaway gap, you're not in a gentle bull market anymore. You're in a repricing event. What the unfilled gap does to the market. An unfilled gap rewires behavior. Bulls get confident. We didn't even give you a dip. Bears get paranoid. What if it never comes back? Sideline money starts chasing, I'll buy the next pullback. And then there is no pullback. That's how a market turns into a ladder. Not because people got smarter, because people got late. And when enough people get late at the same time, the chart doesn't rise in steps, it rises in shocks. 2 paths from here. Fill or rip path. A. The gap fills. You'll see price drift back toward that ghost zone, volatility cools, and the market repairs the move. If that happens, watch how it fills, slow and controlled, or fast and rejected. A slow fill is a reset. A fast fill that snaps back up is a warning sign, because it tells you buyers are camping at the gap like it's sacred ground. Path B, the gap becomes untouchable, price never revisits it. Instead, it builds above it, then launches again. That's when the gap becomes a line in the sand, and every dip gets bought like it's a clearance sale. Which path we get depends on whether the catalyst stays alive and whether the physical market relaxes. What would invalidate the God Candle? If you want a clean technical invalidation, look for this kind of behavior. A weekly closeback inside the prior range, below the breakout ceiling. A gap fill that doesn't bounce. A sharp sell candle that erases multiple weeks of progress. In plain English, if the market comes back down and starts trading like the old world again, the God Candle loses its divinity. But if it holds, if it refuses to trade in the skipped zone, then the market is saying the old price was a mistake. The checklist, if you want to track the next 14 days. Not financial advice, just a framework. Watch these like a hawk. 1. Daily and weekly closes. Do we keep closing near the highs? 2. Any attempt to fill the gap, does it get rejected instantly? 3. Futures curve, does backwardation deepen or fade? 4. Premiums, do retail and wholesale premiums stay firm? 5. Warehouse movement, unusual draws, tight availability language. 6. Policy headlines, tariffs, export licenses, strategic stockpiles. 7. Correlation breaks, silver rising even when risk assets wobble. 8. Volatility, are candles getting larger? After the breakout, that's fuel, not fatigue. If those boxes stay checked, the market is telling you, this is not a trade, this is a transition. The big idea. A $250 print in 14 days would be extreme. But the ingredients that create extreme moves are visible before the move finishes. A higher time frame breakaway gap, a geopolitical catalyst that forces allocation, a physical market that refuses to relax, and industrial demand that can't pause production because prices are inconvenient. That combo doesn't create a gentle uptrend. It creates candles that shock the world. If you're waiting for the market to behave like it did in the old years, you might be waiting for a world that isn't here anymore. Silver is being treated less like jewelry and more like infrastructure. So here's the question I'll leave you with. Do you think this gap fills? Or do you think the market just changed the rules? Drop one word in the comments. Gap, if you think it fills. Candle, if you think it doesn't.